$600 billion. That is roughly what Nvidia is reportedly considering guaranteeing this week for a single customer to buy a single kind of product. Nvidia's own chips. $250 billion to backstop the financing on a new data center. $350 billion to help pay for the GPUs that fill it. The customer is OpenAI. The chips are Nvidia's. The guarantee is Nvidia's. Almost every dollar in this loop starts and ends in the same building in Santa Clara. Today on The Current, we follow that loop because the same week this story broke, Alphabet posted a number it had never posted before in 22 years as a public company, and the stock market erased nearly $800 billion of big tech value in a single afternoon. Those two stories are the same story. Before the mechanics, the stakes. Nvidia, Alphabet, Microsoft, Amazon, and Meta together make up a huge slice of the S&P 500. If you hold a retirement account, a target date fund, or almost any broad index, you already own a piece of this trade, whether you chose AI stocks or not. And this week, the market started asking a question out loud that had been whispered for a year. What happens if the spending outruns the payoff? That question just got a lot sharper because the newest chapter is not about a company spending its own money, it is about a company guaranteeing someone else's. Start with why this deal exists. OpenAI has a straightforward problem. It needs more computing power than almost anyone on Earth has ever tried to build at once, and it needs it now, not in 5 years. The proposed answer is a data center campus in southern Ohio, built by SoftBank's energy arm on the site of a decommissioned uranium enrichment facility, designed to eventually run 10 gigawatts of computing capacity, roughly the output of 10 large nuclear power plants. Including the chips, analysts estimate the full project could cost more than $500 billion, which would make it the single largest data center project ever announced. That is the scale we are talking about before we even get to who is paying for it. Here is the catch. Lenders do not hand out hundreds of billions of dollars on a handshake. They want an investment-grade borrower, a company with a credit rating that says it can reliably pay its debts. OpenAI does not have one because OpenAI has never turned a profit. It burns cash by design, funded by continuous rounds of investor capital rather than operating income. So if OpenAI wants to build a $500 billion campus, it needs someone else's credit to stand behind the loan. That is the opening Nvidia is reportedly stepping into. Not as a lender exactly, but as a guarantor, the entity that tells bondholders, if OpenAI cannot pay, we will. According to reporting this week, the arrangement under discussion has two parts. First, roughly $250 billion in guarantees on the lease and construction financing for the Ohio campus itself, the concrete, the power infrastructure, the cooling. Second, in a separate but related negotiation, up to $350 billion to help finance OpenAI's purchase of the chips that will fill the building. Chips which are, of course, Nvidia's. Add them together and you get something close to $600 billion of exposure, backing a single customer so that customer can keep buying from the company backing it. Nothing about this is illegal or even unusual in isolated pieces. Vendors extend credit to big customers constantly. The size and the shape are what make analysts nervous. The word that shows up in almost every analyst note about this deal is circular. Nvidia has already invested directly in OpenAI. Nvidia has invested in dozens of other AI companies, several of which use that money to buy Nvidia chips. Now Nvidia may guarantee the debt that lets its biggest customer keep buying from it at a scale no bank would underwrite alone. Bernstein analyst Stacy Rasgon flagged this exact pattern as a circular financing risk, warning it can make demand look larger and more durable than it really is. Picture it as a company selling you a car, then guaranteeing your car loan, then counting the sale as proof its cars are in high demand. Each step is a normal business decision. The loop they form together is what worries people who study these deals for a living. This is not a new pattern in tech, even if the numbers are new. In the late 1990s, telecom equipment makers like Lucent and Nortel financed their own customers, so those customers could buy more networking gear, inflating sales figures that collapsed the moment demand growth slowed. The equipment worked. The financing did not survive contact with reality. The lesson from that era was not that vendor financing is always fraud. It is that vendor financing hides the true health of demand until the music stops, and by then the losses have compounded on both sides of the deal. Nobody today is predicting a repeat, but this is the exact playbook that earned the warning label the first time. While this deal was surfacing, Alphabet reported its second quarter results, and one line stopped analysts cold. Free cash flow of negative $5.9 billion. Alphabet has generated positive free cash flow every single year since its 2004 IPO. This quarter, spending on AI infrastructure, capital expenditures that doubled to roughly $45 billion for the quarter alone, outran the cash the business brought in. Alphabet also raised its full-year capital spending guidance to as much as $205 billion. The stock fell more than 7% that day, its worst single session in over a year, even though revenue and profit both grew. Investors were not punishing bad performance. They were punishing spending they are no longer sure will pay off. Alphabet was not alone. Across the so-called Magnificent Seven, roughly $797 billion in combined market value disappeared in a single trading session this month, the group's worst day since April of last year. Meta shares are down nearly 10% on similar spending worries. Taken together, the group has shed roughly $2 trillion from its late May peak. The sentiment shift analysts describe is blunt. For 2 years, more AI capital spending meant a higher stock price. Now more spending increasingly means a lower one. That is the exact moment the Nvidia OpenAI guarantee talks landed, a moment when the market had just decided it wants proof of payoff, not promises of scale. Here is the number that explains the mood shift. In 2023, AI capital spending consumed about a third of the major cloud companies' operating cash flow. This year, estimates put that figure at roughly 93%. Amazon, Google, Meta, and Microsoft combined are on pace to spend around $725 billion on AI infrastructure in 2026 alone, up about 77% from the year before. That is the entire industry's playbook. Spend almost everything you make, plus borrowed money, plus now guaranteed money, on the bet that AI demand will eventually catch up to AI supply. Every guarantee, every circular deal, every vendor-financed loan is a way of buying more time for that bet, to pay off before the bill comes due. So how does this resolve? Watch 3 things. First, whether the Nvidia OpenAI guarantee actually gets finalized, or whether the scrutiny this week causes the terms to shrink, or the deal to quietly disappear. Both companies have said terms are not settled. Second, this week's remaining earnings, Microsoft, Meta, Amazon, and Apple all report within days of each other, and each capex number will either calm the market or feed the revolt further. Third, and hardest to see coming, any sign that OpenAI's actual revenue growth is closing the gap with its spending, because that is the only thing that turns circular financing from a red flag into a rounding error. None of this is a prediction. It is the dashboard for the biggest financial bet currently running through the American economy. Strip away the ticker symbols, and this week told a simple story. A company that makes chips is discussing whether to guarantee hundreds of billions of dollars so its biggest customer can keep buying those chips. In the same week, the market started punishing every other company for spending too much on exactly this kind of infrastructure. Maybe the bet pays off. AI demand grows into the spending, and future viewers of this channel will look back at this episode as the moment before the biggest platform shift in a generation. Maybe it doesn't, and 2026 becomes the year analysts point to when they explain what circular financing actually costs. Either way, the guarantee is being discussed in rooms you will never sit in, with your retirement account quietly along for the ride. That is the machine economy, and you are living in it. Subscribe now, because tomorrow we open the collapse file on WeWork, the company that convinced Wall Street that a lease could be worth $47 billion.